Me? I'm
Good afternoon, everyone. My name is Camille Shaw, and I am the project director of the South Carolina MBDA Business Center, which is operated by DITSA Inc. We work with small businesses throughout the state to help them to scale up, build capacity, and grow. So we would like to give you a warm welcome today back to our final session of the four-part series of business succession planning. In our previous sessions, we've discussed how to avoid common mistakes and contingency planning, how to increase your business valuation, and we talked about the legal and accounting issues. So in case you've missed any of the past sessions, they all are available for replay on our YouTube channel, and we will add that link to the chat room shortly. But today we will discuss how to prepare to transition or how to exit the business. So we look forward to this last session of business succession planning. So before we begin, I would like to thank our sponsors for their support in making this training possible. Next slide, please. So we would like to thank the U.S. Department of Commerce, Minority Business Development Agency, the City of Columbia, the Michigan Minority Supplier Development Council, iSuccess Consulting, and DITSA Incorporated. Next slide, please. So our energetic facilitator has done a wonderful job with guiding us through the process and needs no introduction. So please join me in welcoming back Mrs. T. Renee Smith, CEO of iSuccess Consulting, Inc. in Atlanta, Georgia. Thank you, T. Renee. We look forward to this last session.
Thank you. Thank you. Hello, everybody. I think I'm over here having separation anxiety because this is the last session that we are going to be together. I don't know about you all, but I have had an amazing time with the panelists over the last 3 sessions, and today is not going to be any different. I told Andrew, Jimmy, and Alan, who I'm going to introduce you to in a minute, we don't want stuffy, we don't want boring, we don't want business jargon. We want the real, the good, the bad, the ugly. Talk to us about business succession planning gone wrong, gone wild. So we want to hear the real truth today. So before I introduce our amazing panelists, I want to see how many of you all have been with us the entire time. So drop in the chat. We're not going to be talking to you all the whole time. We want you to be engaged. We want you to be asking questions and commenting in the chat. So let me know in the chat if this is your first session, if you've attended 2 of the business planning, succession planning sessions, 3, or have you attended all 4? So drop in the chat and let me know if this is your first session, second, third, or 4th session. We just want to see who's in the room. Okay, so we have some first session, second. All right, some have attended all 4. 4 sessions, 2 sessions, 1 session. Great. Okay, awesome. So the next question that I have for you is, where is your energy level? Because I want to see how hard we're going to have to work today. So on a scale of 1 to 10, and panelists, I want you to drop in as well. Let me know where you are. 10 is, I'm fired up, I'm ready to go, let's go. 1 is, y'all, I still have on my pajama pants, I just have on a top. And 5 is, I'm halfway in the middle, I just finished eating lunch and I'm kind of sleepy. So y'all need to entertain me. So let me know. So we have some 3s, some 2.5, some 2s. All right, there we go, some 8. So 6.5. Oh Lord, Earl, Thursday is your nap day. Tia, you're at an 8. Byron, 7. Joanne, 5. Dwight, 10. Yes. All right. So I want you to bring your energy. I want you to ask as many questions as possible, and let's get started introducing our panelists. Next slide. So our first panelist that we have is Jimmy. And so Jimmy is the founder and president of Cho and Associates, an engineering firm specializing in civil, structural engineering, land surveying, asbestos, and lead-based paint survey. Mr. Chow is a licensed professional engineer in the state of California and many other states, which means AKA that he's really smart, and he's going to have some amazing advice for us today. So Jimmy's going to share his story with you in a little bit. Next, we have Andrew Cheatham, and he is a graduate from Clemson University State in 2010 with a Bachelor's of Landscape Architecture Design, and he is the owner of KBS Landscape Architectural. Mr. Cheatham volunteers his time in the City of Columbia Tree and Appearance Commission, helping improve the urban tree canopy. And he also received the National ASLA organization as the 2018 Rising Star for his efforts in promoting landscape architecture. Thank you, Andrew. And last, but certainly not least, the mouth of our panel, Mr. Alan Hancock. And if you guys were with us on the third session, you know that he gave some valuable advice. So he's the Senior Vice President of First Community Bank and the Director of First Community Financial Consultants. So he's going to tell you his whole story about how he grew his business, sold the business while he was still in high demand, and then now is working in his dream job, making lots of money and changing lots of people's lives. Okay, so mission on a purpose. So let's welcome our three panelists. And we're going to start off by asking them to share with us their journey or their path to small business entrepreneurship. It's always great to hear all of the accolades, but we really want to hear about the journey, some of the obstacles, you know, that you ran into and how you overcame. So we're going to start with Alan and then Jimmy and then Andrew. Welcome, guys.
Thanks to Renee. I'd say you did a pretty good job of my story. I, right out of college, entered into a profession where I was giving financial advice. I did it for several different companies and learned that I absolutely loved this business and hated the way companies asked me to do it. So I decided I would go out and try to do it on my own. I had enough success that offers started coming my way. And I decided that what I had been preaching for so long, I should practice, which is to have an exit plan and to decide when whatever you have built is this most valuable. And I sold that business to First Community Bank, and I did what is called loosely in our world is a stay and play. I stayed with the people that bought me, and that has been 15 years ago, and I'm still doing it. So my job every day is to do financial advice, but the vast majority of that is around business owners selling and people wanting to buy small businesses. So for today's panel, I will be the boots on the ground, real life stories of how this kind of stuff works. In fact, I was, the panelists know I was barely got here at 11:59 because we had a client situation pop up this morning. So this is what I do every day, all day, and look forward to your questions.
Awesome. All right, Jimmy, and then Andrew.
Hello. As you can tell, I have sort of a catch-up energy from Renee a little bit today. So I just have to remind myself, I need to get my energy level up so I can keep up with Renee and Alan. And I really appreciate that I have this opportunity to share my journey with everybody. I started the business 35 years ago. When I first graduated, I started working for a company. At that time, my cultural belief was I start a company and work there until I retire. And that's how the life are supposed to be. Then, of course, you know, a couple months later, the person, the partner hired me, was fired overnight, and his office got cleaned up the overnight. And that really shocked me because I never thought that a company can get rid of their partners, you know, just like that. You know, what happened to the small peon that like us, you know, so they just totally, you know, start, you know, unravel my cultural belief about my career. Then, of course, for those of you working in a big corporation, I started out at the end of the hallway, and that's a long hallway. And so when I, the gaining my experience, getting my performance, I start getting promotion. I move up down the hallway. The end of the hallway was become the director, which is that's the path. One day that I took the briefcase, I was walking down to the hallway. All of a sudden, I got scared. I was looking down the hallway. For some reason, I saw that's the end of the life. I can see my tombstone down there. I said, man, I'm still young. I'm not ready to die yet, but I can see my whole life, my death is right there. So I got scared. Then I knew I got to do something else. So that's when I decided I need to have my own business. So the future is not written, and there is all depend on how I want to the painting with my brand new brush. So that is kind of exciting me. That's how I started now. Now all of a sudden, 35 years later, then it's getting to the time that I've been thinking about, what do I do with my business? So of course, this thing is not just pop up at the end. I have the luck of attending a lot of seminar, and this is when you want to plan your exit, you need to plan it at the day you start your business. And I sort of follow that. So when I started out the business as a one-man show, I know I need to grow the depth, and so I can create some value. Otherwise, it's just one-man show have no value to the purchaser. And so I start building up the company. And then the next challenge would be when you sell, how about your legacy? A lot of entrepreneur, you started that because you have passion, you're part of what you do. But when you sell, then if you sell externally, then it could be the name is gone. So your legacy is all gone. So that's something that got me start thinking about, should I consider internal transition or external transition? And another part of that is also you have to think, if you want to sell, what is the value of your company? And so how to the value of your company become another challenge. So hopefully that we're going to share all those stories with everybody today, and hopefully can get benefit from our life journey.
I love it. Jimmy, you just gave the whole workshop in your introduction, those last 4 points. Thank you. All right, Andrew, last but not least, let's talk about your journey.
Yeah. Thank you again. This is Andrew Cheatham with Ken Simmons and Associates for having me today. I'm a landscape architect. You may not know a whole lot about landscape architecture, but a lot of landscape architects are entrepreneurs or self-employed, or at least work for, at least 80% of landscape architects work for small businesses. And I graduated in 2010 when there were not really any design. Jimmy can probably tell you, not a whole lot of work out there in the South Carolina construction market. I actually went and worked for a design build firm, and there were some days I was doing some design, but for the most part, doing a lot of manual labor. And unfortunately, that business went out of business. And with God's providence, I was actually across the street from my former employer, Ken Simmons, one morning doing just some freelance residential design, and ran into Ken. I met Ken through working with the contractor that I was working for, doing some installation work that he had designed. And lo and behold, he had an employee that had been with him for a long time, that had to move for a spouse's transfer. And so he needed an employee when no other landscape architecture firms really in the nation were hiring. And so I got a job that was 12 years ago, and had worked here ever since. And during that time, Ken had 50 years plus experience. Our firm started in 1946. His father had started the firm. He had taken over the business, actually became partner, bought out a partner. So he was a second generation owner, and his family, his two sons, had no interest in the business. And then so we started talking about what it would look like to have an internal transfer, to use Jimmy's words, probably 7 or 8 years after I had worked here. And then that was kind of the end goal. And 3 years ago, took over ownership of the firm.
Awesome. So we're going to ask you to share some more details about that in one of the upcoming slides about how that process went through. Okay, next slide, please. Let's just do a little poll, all right? So I want everybody to answer the question, do you have an exit or transition strategy? So the poll has been launched. Do you have an exit or transition strategy? Yes or no? Let's see who we have in the room today. Do you have an exit or transition strategy? All right, let's stop the poll. All right, so more than 71% of you do not. So you are in the right class. All right, next question, please. Next poll. Have you determined how you would transfer business ownership? Yes or no? Have you determined how you would transfer business ownership? Yes or no? And as Andrew was talking about it, the internal transfer is when you're selling the company to someone in the business, and external transfer is if you're selling it to somebody outside of the business. All right, let's stop the poll. All right, so 75% of you have not decided how you're going to transfer the business, and 71% of you all do not have an exit plan. Next poll. And actually, I'm going to ask a different question than this. So we're not going to launch the poll. I want you to drop it in the chat. And it's based on Jimmy's question when he was talking about, or not question, but his statement, when he knew that the business could not just be him, like a solopreneur, he had to build a team to be able to increase the value. So I want you to answer in the chat. Does your business revolve around you? Are you a solopreneur? Does the business revolve around you? Yes or no? So if you were completely taken out of the business for a month, would your business be able to operate without you? So drop in the chat, yes or no. Yes, my business revolves around me. No, my business does not revolve around me. And next slide while they're answering. Okay, so it's half and half, it looks like. Half, yes, the business revolves around you. No, half, it does not revolve around you. Okay, so either way, it's fine, because today we're going to talk through if the business revolves around you. So CEO action steps to successfully transition or exit the business. So number one, foundational work, which we're going to talk about, strengthening your infrastructure because that increases your business valuation, understanding what happens to the pre-sale, buy-sell agreement and due diligence, what happens during pre-closing, closing, the post-sale, and business training. Next slide. So we've documented all of these steps in this PowerPoint for you. So you will actually get the PowerPoint afterwards. So you'll do the step-by-step method. We will go over the majority of the items within our conversations, but we're really going to focus on step one, doing the foundational work, and step two, because those are the most important parts. And we're going to have Alan really to share some stories with some of the clients that he's worked with about some planning that did not go too well and different things that they could have been doing. And Jimmy and Andrew will, of course, give their expertise as well. Next slide. So I want to make sure that you ask all of your questions that you have in the chat, and we'll answer them as we're going away. Do not leave this training with questions that you have that we could have answered. Okay. Everybody's, the information that they're going to give you is invaluable today. Okay, so this is some of the foundational work that you want to do. So number one, you really want to overcome the emotional attachment to the business, being able to separate your identity from the business, because I think that's very key. So I'm going to ask the panelists to share, what are you currently doing? So as you get ready to retire, and Alan, what did you do to separate yourself? Because you put so much time and effort in building your business, it really becomes a part of your identity. And so oftentimes CEOs, they do have separation anxiety. I joked in the beginning, but they do have separation anxiety about what's going to be next for them if they exit or transition the business. So Alan, I want you to talk about what you did do, and Jimmy and Andrew, what are you thinking about doing? Because you do definitely want to plan your exit from day one. All right, Alan.
Yeah, I would say that what I did occurred probably 10 years sooner than I thought it would. So I was sort of opportunity provided to me driven, as opposed to what we're probably going to talk the most about today, which is you've gotten to a point in your business where you probably need to start looking for opportunities or figuring out what yours might be. So my personal situation there may not be as good or as much help to the participants as what I do every day for clients.
Or you
Uh,
can tell us how you advise your clients.
yeah. So the end of the day, the size of business matters, and then what T. Renee was just saying about what you do. Your business is probably going to fall into one of two categories in two different ways. And the first one is just simply the size of it. The vast majority of businesses in this country is, you could argue, is what define makes America great. They're doing sales of somewhere between $0 and $1 million, $1.5 million. If you've got a reasonable profit margin, your net or your take home is probably somewhere between 0 and $500,000 type dollars. That size business, we tell our clients, you're going to have to prepare to be your own broker. You're not going to have people calling out of nowhere offering to buy that businesses. The venture capitalists that you hear about are probably not even looking at businesses that size. It doesn't mean there's not opportunities there. What you've built is tremendously valuable, but you're probably going to have to sell yourself a little bit. You're probably going to have to go out there and look for opportunities. We've already talked about internal versus external. Those opportunities are going to fall in one of two ways. Either you've got a family member that you ultimately would want to work with on that business, or you've got an internal employee that is a key person that you couldn't live without. Those are the paths that you start to go down there. So my personal situation, I knew all that. I was advising clients that way, and all of a sudden, out of nowhere, because of some business relationships I had an opportunity to have some offers. But that's probably abnormal for what you would normally see, and it was well before what I normally would have expected that to happen. And when it started occurring, I started thinking, well, before I just dismiss this out of hand, why don't I practice what I preach and sit down and look at what the offers are and see whether it really makes sense or not to do that. The other big dividing line there is going to be what you do as a business. If you are what we call a public service corporation, if you are an attorney, if you are a doctor, or if who you are and the identity of you is critical to your business, it's going to be even harder for you, because you're trying to determine the value of something that is largely dependent on you, and you're trying to determine the value of it without you. So if you are not a public service corporation, if you have a product, or if what in our world, if you make widgets, if you are a butcher, if you buy quality meat and cut it up into the right pieces, as long as your clients see the name on the door, and as long as they keep getting good meat from there, they may not necessarily know who owns that business. As long as the name doesn't change or what have you, you probably have more options, because there's value in the fact that the clients aren't necessarily going to miss you. So those are the things that I would start thinking about as you go through some of those things. Prepare to be your own broker, prepare to be trying to create the interest in your business, and prepare to have to massage that a little bit, because you have probably created something that is valuable enough that most people can't afford, and you're going to have to work with them to try to figure out how to do that. So for now, is that good enough to your name?
It is. And Jimmy, before you go, I have a couple of questions for the audience. So please drop in the chat and let me know, is your business closely tied to you? Or do people work with you because you are the owner of the company? Do they work with you because of you, or do they work with you because of the service that you provide? Okay, so I have two answers. All right, everybody, I want to see everybody's answer in the chat. So I need some more answers coming in. Do clients work with you because of who you are, or do they work with you because of your business? All right, I still need probably about 15 more people to answer. I want to make sure that everybody's included. All right, so a lot of them are because of who you are, or a lot of them say both. And just a personal story for me. So I started my company when I was 19. So I've had it about 5 years. No, I'm joking. Almost 30 years. I'm joking, people. Almost 30 years. And so we started transitioning maybe about 5 years ago because the company was built on based on who I was. And so we realized that we had to systematize the business and we had to remove me as the face of the business. So that's a whole process. So everybody here that they're working with you because of who you are, it is a way of figuring out how to systematize your business and then putting other people in place. Because if you do look to transition or to exit the business and it's not from someone internally, as Alan was saying, that could be difficult. The second question that I had is when do you, so let's see, Luis, because of who I am, reputation is transferable, but relationships are not. You're absolutely right. And so, Louis, one of the things that was important to us was to put processes and systems in place so that those systems could be duplicated, and ensuring that we had the right people that fit our culture to be able to execute on those relationships. So that it's a very tricky, thing to do, and it's a fine line to walk. So let's also drop in the chat and let our panelists know, when are you looking to transition or exit the business? Would it be in 5 years, 10 years? Are you just getting started? So you're going to be there a good 30 or 40 years, 50 years. So drop in the chat just to let us know when you are looking at retiring. Okay, so far we have 15 years, 4 to 5 years, just starting out. Okay, so for George and for Lori, who are 4 to 5 years, tell us where you are in the process of transitioning and exiting. And I need probably about 30 more people to respond in the chat. Okay, everybody, we want you focused, present, and responding. So anybody that puts down 5 years or less, let us know where you are in your thought process of exiting or transitioning the business. Okay. All right. So Jimmy, if you could talk to us a little bit about your process that you went through to go from solopreneur and where people were getting the business directly because it was you, to being able to strengthen your infrastructure where the business is not tied directly to you. And Andrew, that's going to be the same question that I have for you as well.
Well, thank you, Renee. I think needlessly to say, the majority of our audience are small business. And as we all know, when you have a mega business, Fortune 500, their transitions are a little bit different than the small business. The reason that we start our own business is because you're either passionate about something, or you want to do something either for you or for your family. So you have a passion that's a must-have. And because of that passion, most of the small business you can survive and thrive is because of you care, and you would put in your time and effort and make sure you can satisfy your client, because if the client is not happy with your service, your product, they will not coming back. So one of the key things for the success of small business, we deliver what we said, and that is very critical. And because of we care so much about reputation, about the client, the satisfaction, and so that's inevitably we become the face of the company. A lot of people, the client deal with the small business. They know we are small business, but if they can trust you, they can count on you, and that's how they won't stop business with you. And so that is good and bad, because the good part is because you have reputation, and that is actually a goodwill. You can sell. But on the other hand, when you try to transfer that, as Dr. Lin says, that is not transferable. And so a small business, the first things we need to to understand is, how do you transfer those goodwill? When just put yourself in the shoes of a buyer. When people buy you, they want to make money. That's the only reason they want to buy. They want to make money. But how do they make money? That means either whatever they buy from you can continue. If they cannot continue, then there's no reason for them to purchase you, because they cannot make money. And so that's something you need to think about it. if your product, if you sell good product and the product is good margin and good quality, and that itself, it's a goodwill. So hopefully you can repeat that. But if you are in the service business, as you know, that is much even tougher, because what you sell is your service. You don't have a tangible things to sell. Then the your confidence to that client, your potential buyer, those revenue and those relationships can continue, and that is the key thing. So as Renee, here's something the on the nail is, that's what I try to do is, I try to build up my company. And so we have right now we have about 25 people. We have 7 licensed engineers. So that's how I intentionally do that, and so that people know that although Child Associates is mainly me, but it's not only me. We have a team of the people. They can either also provide good service, and they can produce. And so that's something I think everybody need to pay attention about. Another thing is is when to plan. The earlier you plan for the transition, the better you are, because that's how I realized through the out of transition. I learned I need to build up my team, and so my company is not only about me. And another thing is when I'm doing the evaluation, I started to realize, hey, I need to be be mindful about build up the client. The client is repeat client, and I can have documentation to demonstrate to that. So it is not one time the business. And then another things, I start realize, when I'm ready to exit, actually, as Alan says, which I want everybody to pay attention. When you sell, you have to pay attention to the tax consequence. And also, a lot of people, they are doing this, to help you to buy and sell, so-called as a broker, and they're gonna charge you an arm and leg, and they may not necessarily what you need to do. Most of the small business valuation, actually, as Adam says, only you knows the best. So how to evaluate this? You really need to pay attention and talk to the person that were interested in you, rather than the interest in just making a fee out of the transition. And so all those type of things you need to prepare. Personally, I care about my legacy, my reputation. So that's reason I been doing this transition for 5 years. I eventually decided to transfer internally. So right now, my next generation, which is my nephew, already stepped out to be president of a company. I'm staying as a CEO, so I can make sure we have a smooth transition. And that is the key, because to me, my reputation, my legacy is more important than just the money. And so that's the reason, I decided to go to transfer internally. Hopefully later on, we're gonna talk about, the transition is not on the mouth. People have to pay you, right? How do they pay you? External, no, it's a whole lot easier. They can just write you a check. Maybe not one time, maybe in a matter of 3 to 5 years, and that's one thing. But if you want to do it internally, where the internal people can come out the money, so there's a lot of things you need to think about. But anyway, start early, know what you want to do. They will help to guide you your exit strategy.
Jimmy, I have one question for you. So as you started transitioning where the clients were not just doing the business with you, was it a difficult process to get them used to working with your other team members? And how did you navigate that?
Well, as I mentioned, I decided to transfer internally since I'm still remain on the business, and my successor are also in the business with me for the 15 years, and so those transition is seamless because
the clients already had experience with them.
Exactly, but I also have a discussion with the external, potential buyer. They made me an offer. They also the key thing is they want me to stay on for 3 years to make sure that I can help them to transfer all my business relation to them. And that is biggest challenge because people, they are doing this business with small business because they trust me, they trust my company, and they just want to make sure those relationships can be transferable because that's why they're buying the company for. Yeah, that they are most of the people they're buying externally. They're either buying the market or they're buying your relationship. I think mainly it's both combined. They want both. They want your market. They want the relationship. So if you sell externally, you have to make sure that you can convince that your buyer that you have a reasonable good chance to transfer the relationship to them.
Awesome. Thank you. All right, Andrew, before you go, I think Alan has something that he wants to say.
Yeah, I was just going to add to that. Jimmy made a great point. The two things we tell clients, if you're trying to transition, there's two things that create real value, and that's helpful to maintain the clientele. It's also helpful to get the most value out of what your business is. And those two things are a personal one-on-one face-to-face conversation with your clients where you say, I have designed my exit. This is the person I have hand chosen. I trust them. The more you can have that conversation, and the more you can tell folks that these people are going to continue your business legacy at your selection, that is valuable. But the icing on the cake is if they can actually see that coordination. I don't know how you deal with your clients. My clients, I have an annual review with. So when we're going to talk with a client, for me to start to create some type of succession there, they want to see you working with them. If you make widgets and they come into your store one day to buy widgets, if they can see you and see the friendliness and see the coordination, it's such an easy thing for them to transfer over. So I would absolutely add to that, that if you're looking at doing that, sometimes you have a business where they're already seeing, if you're selling internally and they've already seen one of your top employees working with you, you may can check that box off. But if they haven't, we would tell all of our clients to make sure you include letting your clients visibly see that coordination in terms of them remaining with the business, which helps you get the most value for it.
Awesome. That was great. That was great. Okay, Andrew, a question for you. Is a business 100% revolved around you, or do you have it revolved around systems and other people?
Yeah, so we're a small business. We have myself and four landscape architects, one office administrator. I would say our business is heavily revolved around me, but fortunately, I'm a little different in my stage of career. I would consider starting out, being a business owner 3 years. My transition has kind of played out this way. It was obviously an internal transition, but my former boss, Ken Simmons, has stayed on as a part-time employee. We say we've switched roles so it helps with the client relationships. The name has stayed the same. He is a mentor to me, and then it allows him he's able to be a landscape architect, not worry too much about the business or administration side. So if to say it all revolves around me, if I got hit by a bus tomorrow, he could easily pick it back up and continue it gives some stability to our company, to our clients, to know that he's still has a hand as an employee. As far as the transition, I've experienced the transition or saw how he transitioned it. As I said earlier in my kind of my journey, we started talking about it probably about 5 or 6 years before it actually happened. And then as it got closer to it, we became more of a final date. This is the year, and I'm sure we'll get into the actual steps that we took. But 5 years out, we started talking about that in front of our clients. Our main clients, it was brought up. I'm here to stay, but our company's here to stay, but the future is in, the ownership is in Drew. And just as I think Alan said, that was kind of where the point I wanted to make, that we went around to all our longtime clients and explained that. One of the other things that I was thinking about as the transition was starting to occur, I had the fear of, okay, well, it is the identity of the business with Ken. When he goes part-time, are people going to begin to start looking elsewhere? And so in my mind, I took a kind of mentally, what clients do I have or that work directly with me? Could I support this business if something happened to Ken, would I have enough client base to, continue to operate the business? So those are some questions that I had in my mind, and what I kind of worked through as those days ticked away when you're until a full transition.
Thank you. And so we're going to go through this slide, and I'm going to come right back to you for you to kind of walk us through the steps that you went through. And as we're going through this, if you all have any other ideas or suggestions for our participants today on what they should start doing now to prepare for the transition, whether it's internal or external, please pop in and let us know. And we have some feedback in the chat, which I'm going to read in a second. But the first thing we talked about is separating your identity from the business. As everybody is saying, start growing your own successor. And I'll have them to talk about that in a little bit. Determine what's most important to you. Jimmy talked about a little bit, profits or legacy. Most of the time, if you're doing an internal transfer, like as Andrew was talking about, you're able to maintain the legacy of the company. But oftentimes when you do the external transfer, it is more about the money. They may change the name. And so you really have to walk through and talk about the importance of the profits versus the legacy. You also have to ensure that you have a solid retirement plan, not including proceeds from the business. And Alan, I want you to kind of talk about a couple of the transitions or a couple of the business sales that you had contracts for, but it didn't end up working that way. We're talking about owner financing, understanding the pros and cons. And then lastly, being realistic about business evaluation for small businesses using the profit multiplier method. And so when we were doing our prep call for this, we really talked about how a lot of small businesses are going out and they're spending all this money on business evaluations, which is really more so for larger businesses. So I want all of the panelists to talk about any of these points that you have some information to add, and then we'll get into the chat. And so if you have questions about what we're talking about, make sure you drop it in the chat. All right, so Alan, you go, then Jimmy, and then Andrew, please.
Yeah, it's like you're reading my notes to Renee. So there's a lot of an element of this part of selling businesses that is very much what you can read in a book or what you can see on a video versus the real life and how it works. And I would tell any small business owner, in fact, I do multiple times a week, if you are preparing to transition a business and it is in that, 2.5 million in down sales, $1.5 million of net income, be very careful of professionals that want to help you sell that business. It is, and that could be a business broker that would be looking for some type of a cut of that. That would be certainly business valuations would fall into that. Look, if you're a business that size, whether it's built around you or not, no one knows that business as well as you do. And it's not like an appraisal of a home where you have a readily made market and there's a multiple listing service where you can go say, hey, on a square foot basis, this is what my home is worth. You have to go through the process of figuring out what that unique business is and what it's worth with or without you, depending on how you're doing it. So something that we tell our clients all the time is, like I said earlier, you better prepare to be your own broker. You better be prepared to create the interest of who you might ultimately sell to. But we tell clients all the time, no one knows as much about your business as you do. So if you were buying your business from you, what would you pay for it? Because anybody that comes in or tells you this dramatically different number than that is probably wrong. And they'll have these reports that they've run. They'll be colorful. They'll be graphical. Unlike an appraisal of a house, they're generally not worth the paper that they're written on until you get to a certain level. It's going to be built on a multiple of revenues. They're going to have to take into account there might be some loss of business because the person who built it, y'all, are not there. So we would tell you to basically have an idea in mind of what you think the business is worth, and then sort of start to create a scenario where you are starting to find the people that will work with you to create a market for your own continuation. The second thing T. Renee mentioned is it would fall under the heading of what we tell business owners is prepare to get the short end of the stick. And it goes back to what I said earlier. If you are a seller, you have probably created something that has more value then anyone should pay for it without you involved in it. So it is a very, very difficult process to successfully transition a small business, almost regardless of how you define small business. So you have a lot of opportunities to do some owner financing. You'll have a lot of opportunities to do some different things with putting up your sales proceeds as collateral for a loan. Sometimes we've seen clients flat out ask to sign on the loan of the buyer who has to go get a loan. All of those things can be very difficult. They can be fraught with problems. T. Renee mentioned a couple of scenarios that I brought up in our preparatory call. A lot of people think a successful owner not being successful is the reason that a longer term buyout might go wrong. It doesn't have to be that way at all. I had a architect who Andrew and Jimmy probably would know, who decided to sell out of a business that he created from scratch. His name was one of the names on the wall. He entered into a 6-year buyout plan in 2007. If those of you that are old enough to know, we got about 2 years into the 08-09 financial crisis, and that person didn't collect the last 3 years of their buyout. It wasn't because the remaining people weren't transitioned properly. They did everything we've said on this call. The market absolutely collapsed and they weren't able to pay. And even though we had put some personal guarantees in there, this architect wasn't going to go throw those people out of their personal homes. They were his business partners. They were his friends for life. So as a business seller, you really kind of have to prepare to get the short end of the stick. You're going to have to create your own market. You're going to have to work with any potential buyer. Every now and then you'll have a bank come in and say, hey, we'll write a check. It's good. That happened to me. I wasn't looking for it. I'm an outlier. But probably you're going to have to be prepared to create your own market. And I would be very, very careful about people around you offering to provide analysis or anything like that, because at the end of the day, no one knows what your business is more than you do. And whatever you would pay for your own business is probably where you ought to start.
So, Alan, can you also talk about why the CEOs need to have their own separate retirement plan outside of the business, and then also how you calculate the business evaluations doing the profit multiplier?
Yeah, that's great. You're so good at following the topics and making sure we touch on them all. So I really mean that. The healthier you are as a business owner, and the financially, meaning health as well, but financially healthy, the more you're able to be flexible. We just got through saying, prepare to get the short end of the stick, prepare to have to adapt for a potential buyer. The healthier you are financially, the more you're able to do that. So the architect that I mentioned earlier, I was a little bit unusual in that situation because that person was my client. So was the remaining business going to be my client. So if I was an attorney, I'd have a conflict of interest. I probably would have had to step out. But we talked to the selling person to say, look, you're going to be fine in your retirement, whether this payment ever happens or not. You got to be careful, because when you're going through those conversations, you have a tendency to say, yeah, but it's going to be fine. I mean, the market's great. You're going to get paid. Well, sometimes you don't. So the healthier you can be on your own retirement planning, the healthier you can be on your own financial legacy. If you're counting on the payment of that business to be most of how you live in retirement with Social Security, that's a red flag to somebody like me. If you're my client and I'm talking to you, I'm saying, we better develop a lifestyle that is not so dependent on this business sale, because you just never know. Every now and then you get a venture capitalist to come in from Atlanta or something and they write you a check, but that's at the size business that we're probably talking, that's not as frequent. And you've probably already had those offers and know those things are out there for you. So yeah, the healthier you can be financially with your own retirement plan, with good old fashioned cash in the bank, responsible levels of debt that are secured properly, the more able you are to be flexible, and you're probably going to have to be flexible.
I think that's really great, because oftentimes when you work so hard for your business, you put so much into the business and maybe not necessarily as much into your own financial planning. And then just to know that you cannot 100% count on the business, you still need to be okay. I think that that's very key. All right, Jimmy, can you add anything, and then also explain the profit multiplier method, if you actually will give us an example of it?
Well, actually, I'm so glad to follow Alan and follow you, Renee, because you guys all hitting the key point that, I don't have anything new to share, but I do want to echo and emphasize the importance. Being a small business owner, most of the time we forget to, or we don't have the resource to build up the retirement, the plan for you or for your staff. And that is very common, but it's very, very dangerous because you surely, cannot depends on sale of the business as your only means of retirement for many, many reasons. And so that's one thing I definitely want to, encourage everybody to start your 401k early. I was kind of lucky because, because of my cultural background, I believe the company belonged to all the people. Although I'm the founder, I'm the 100% owner, but the company belonged to the whole company. So I started my 401k early on, and because I want to take care of the people working for me, make sure when they retire that they have a means to live. Again, that's my cultural background because I believe we go to the company, we're there forever. So it is a owner's responsibility to take care of everybody. So we are kind of lucky on that in a sense. But regardless of what you're thinking, you have to start your 401k as soon as you can to prepare. Could be the short end of stick, as Alan says. And many, many times you may think that this is your exit plan, and that's the exit plan oftentimes may not go like what you the hope to be. As I mentioned personally, I originally tried to build a business I can sell to somebody else. Then toward the end, I starting value the legacy part, the more than the monetary part. And so then all of a sudden my thinking start changing, and that's quite could be quite a difference in the price. The way you're getting your payback is whole lot different. The picture. So that's something the earlier you prepare financially, the more flexibility that you can have for the exit. The other part, I also want to echo what Alan just says. A lot of broker, they were seeking you out. That especially on the professional service business, we got that call all the time. My advice personally is try to understand your business better, and so you will know fundamental idea. Don't rely on those a broker, because that really charge you too big a fee, and that really provide a little service to you. I have attended many seminar to how to valuation of your business. For every business you're in, you need to go ahead to get some kind of general idea, because like a professional, like engineering, the typical profit margin is about 10 to 15%. And so that's the reason all those the webinar, they will tell you, okay, well, a lot of those sales based on your gross revenue, because once your gross revenue is about that 6 million, then your profit is about the 100,000 to 150. Then people can use that to value your business. So as long as you know that, so you build up your value. Another important things that I learned is the people won't care about your net profit, because that's why people want to buy you. Although the revenue could be some representation, but depends on how lean and mean of your organization, that the bottom line is different. So a lot of people also pay the great attention to your net profit. Typical rule of thumb is for the close transition, and people try to buy something that closely. This is different when you buy a stock from a big company. That's the things is a whole lot more the accountable, so you will know your rate of return. For the small and so-called close-held business, people typically expecting to get their return back between 3 to 5 years. So whatever your net profit, you can just times 3 or times 4 or times 5. That's roughly what's people going to pay you for. So once you know that, you can work with your financial advisor, work with your accountant, and you can pretty much know how much your company can worth. And so rather than to going through spend a bunch of money and end it up, not give you a whole lot of help. And so those kind of things that I want the offer. So make sure you have your 401k. Do not depend on the sales of business to make the exit plan. And second, try to know about yourself. What is your industry average cross the average the profit margin, and that's why people want to buy your business for. They buy that because they want to make money, and there's some kind of expectation how soon they can make money. And so that is all kind of a logical things. As Alan said, the things best. So make sure you have general idea, then work to achieve that. And not only that, but you have a good documentation. That's another thing that I want to emphasize. A lot of small business doesn't have a good documentation. And I have learned that, and so because I want to sell my business, one day I want to exit plan. So I've been prepared. My accounting record is very, very clear. So you can demonstrate to people that here is your profit, the tracking for throughout the years, and everything is audible. So then they be a whole lot more, the convincing your potential buyer. This is not something that is just a pie on the sky. Is actually repeatable and deliverable. And I think that will be very, very helpful for you want to exit. Doesn't matter externally or internally.
Now, drop in the chat and let me know if you all got all of those amazing truths that Jimmy just gave us, okay? So just to summarize, one, when he was talking about the profit multiplier, and that's the most realistic way for small businesses to evaluate your business, you're multiplying 3 to 5 times what your net profit is. So you look at your expenses, you look at your revenue minus your expenses to get the net profit. So if you have $100,000 in net profit, you'll multiply it times 3 or 5, which is like $300,000 to $500,000. And that's what a typical business or typical person will pay you for your business. So if your net profit is $100,000, then you should not be trying to sell your business for $20 million. That business valuation does not line up. Okay. Is that correct, Jimmy? Is that what you were saying? So yeah. For you to sit and look at your business evaluation. So everybody, I want you to just take a quick second and I want you to think about, because you should know your numbers, at least your net profit, you should know your number. I want you to think about what was your net profit for last year. And then I want you to multiply that number times 3, multiply it times 5. And then when you get your number, if you were to sell your business today, that's kind of a realistic number of what it would be worth. Okay. So if that makes sense, drop makes sense in the chat, because we want to make sure that we're giving you practical tools to understand. So that's what the business multiplier is. Okay.
And T. Renee, let me add while they're putting that in the chat, there's a little contradiction there. So think about it. For all the years you've run your business, you meet with your CPA in the 4th quarter of every year to plan next year's taxes. What do you try to do? You try to make your net income look as low as possible. So now all of a sudden you're starting to talk about somebody what your business is worth. And now all of a sudden that net income includes that car you run around in, all the dinners you bought that might have been your family. So I understand we're in the real world. We're not, this isn't theory. So the more you can, like Jimmy said, the more you can have a handle on that and explain that to whomever, the better, because you go from wanting your income to look as low as possible to needing it to look as high as possible, so that multiple looks as good as you can. So
Alan, we can just end the webinar right now. You have said a mouthful right there. So what advice would you give people? Meaning, let's say, okay, I'm looking to exit the business in 5 years, right? So everything that I did prior to the 5 years, I took all the write-offs, I made all my expenses as low as possible, but now I have to shift direction and I really have to work on showing higher net income. Like, how much time should they have where they're showing great income to really make the business viable? And I know it's different, and this, go ahead and put your disclaimer. This is not financial advice. We are just having a conversation. Go talk to your financial planner.
I'm not as burdened by the attorney in the last session. I can give what would be considered some financial advice in this webinar.
Okay.
I don't think you need to make books look good. I think I think
And when
you
I
need
say
to-
don't look good, I mean you literally are doing it correctly and
right.
honestly.
I think you need to be able to explain whatever it is. Anybody that's going to run your business is going to know that not every single line item on that spreadsheet was going to be, and we don't say legitimate, we say necessary business expense. Okay. So
Wait a
the
minute,
more,
Alan. Everybody type that in the chat. Necessary business expense. I like that.
so
Okay.
not only am I advising clients every day about buying and selling businesses, I'm also trying to buy and sell other financial advisors' business. So I'm having these conversations on a regular basis. And it is nothing for us to sit down and say, in your list of income, what of it probably absolutely goes away when the name changes on the door? Of your list of expenses, what absolutely goes away? Like, what is that country club membership? What do we call that? You know, so there's always going to be some of that. But as long as you understand, once again, no one should know as much as you do about what you would pay for your own business. I don't think you have to go through a 3 or 4 year period where you eliminate unnecessary expenses. But I think you need to be able to sit down with someone on a spreadsheet or a P&L statement. Like Jimmy said, the more you can know about that business, I know Andrew feels the same way, the more you can sit down and say, look, this expense right here, you're probably not gonna have to worry about that. You know, so, and to the extent that you're talking to somebody that you're gonna have a nice transition for, they'll actually see some of that. They'll be able to, but the other thing I would say is be prepared to value that business on a revenue basis or a net income basis. If you get to where the potential buyer is looking at you sideways, like, you mean to tell me 35 or 40% of these expenses are not necessary? Well, then let's just go, we can prove revenue for sure. Let's go and talk about a, you know, Jimmy said 3, 4, 5 times revenue picture. I would be prepared to talk in either term, net income or revenue, but one of the two.
That was great advice. And I love the necessary business expense. Okay, Jimmy, what do you want to add? And then Andrew, we're coming to you if you have anything that you want to add to.
All right.
Well, definitely I agree 100% with what Alan just said. You don't need to change any of your practice, because if you changing that, you know, the shifting your accounting, then you just, what that means, you're going to pay a whole lot more unnecessary tax. And so I think that's the challenge as a small business. We want to definitely pay our taxes, but also we don't want to pay more than what our fair share of that part. So I would definitely echo what Alan just said. Just do your business, you know, the accounting, the procedure, working with the accountant, you know, closely, and don't do anything else. However, your accountant and yourself should know, as Alan said, what is so-called necessary or critical spending, you know, of that thing. So that can easily back it out. You know, that's what I did. You know, when they have external people trying to buy, every business owner knows how to, you know, handle their business books. So our accountant can easily back it out as well as their accountant. So I don't think that is something we should do anything. Just still concentrate on build up your business value, which is, you know, either increasing your margin. If you are typical margin, like as I said, the engineering is the 10 to 15% profit margin. If you can help to improve that, so okay, well, I have a 20%, you know, profit margin, they make your company more valuable, and that you can tell the potential buyer, hey, here is your typical, you're used to use a multiple of 3 for multiple, but I think I can worth 6. Here is why. You know, you can make your payback whole lot sooner. You know, so you have to have a way of to deliver the conversation that your business worth what you think it is worth or more, and here is why.
Valuable information. So now there's a question in the audience, and so we need for you to clear this up, please. So the question is, does necessary expenses drift in the practice of cooking the books? I am afraid of that approach.
No, I'll take that since I brought it up. Not at all. In fact, the business owner that's going to succeed you probably is going to have borderline necessary expenses as well. And don't hear us say, if you've got a beach house that no one has ever been to but you and your family, and you're writing it off as a business expense, you're going to need to talk to your CPA about that. We're talking about normal course of business things. If you have a car that you drive to work, some business owners choose to lease that car and lease it in the name of the business. There are certainly ways. You may have a home office that you have decided you're going to section off the square footage of, and you're going to use that as some type of a business expense. If it's totally fraudulent, that's between you and your maker and your CPA. But there are absolutely things you are probably considering a business expense, whatever retirement plan. I just answered a question in the chat. Whatever your savings level, the new business owner may say, I don't need to be saving that much for my retirement. They're wrong, and we'll help them figure that out. But that's a not necessary business expense that they may not want to see. So I couldn't tell quite where that question came from in the chat list, but actually I can now. So Lewis Lynn, that we're not talking about anything nefarious outside of the realm of proper accounting, but even in the realm of proper accounting, there's going to be things that you should be using strategically and ethically to bring your income down, that when it comes time to create a value of your business, you won't include it back.
Lewis, does that answer your question? Does that make sense? And then what Alan, go ahead.
If I can also the piggyback on that, we are definitely not saying anything about cooking the book. That is very, very bad idea. Not mentioning that that's illegal, but it's also not very smart. We are talking nothing about that. What we are talking about is, Alan, for instance, being a small business owner, if you purchase, the gross weight 6,000 and more, you can expense the car rather than to paying tax on that. That is perfectly legal within the normal the business practice. So those kind of things. So if you're driving the company car, fit that the profile, that's not something that typical tied to the operation of a business. That's something they can be back out. And also, for instance, as a small business owner, you have a lot of the tax incentive. You have a small executive retirement plan, and those type of thing is because of you owns the business as small business, and so you can take that kind of the contribution to your retirement. Those type of things also can be backed out, because although it is part of our IRS process, but that's something it's because of the benefit being a small business. A lot of we have executive compensation package, those type of things, above and beyond the normal employment, those kind of things. That's what we're talking about. Definitely not with the 100% do not agree and not try to encourage to cook in the book.
So,
yeah. And Renee, I would say businesses that have an inventory component, if you're somebody who buys inventory that you sell a product, we have conversations constantly in the fourth quarter of the year. Could you go ahead and advance pay for some inventory? So you'll have a lot of, but yet business owners, when they're talking to a potential succession plan, will forget to include the fact that they've got inventory sitting over here that was worth a lot because your accountant suggested that you pay for it to get that ahead. Another very common thing that people will do outside of inventory is, if you're trying to advance pay for equipment, if you have a remodeling of your business, or you're going to go buy new furniture for your business at the end of the year, even if you weren't thinking that, sometimes your CPA will suggest that you do. There are 178 is a code 178 expense where you can depreciate that all right up front. So all very legitimate things. But when somebody looks and says, wow, you kept your income under $100,000 every year for tax purposes, that's not really what the business is producing.
right.
And I would just like to add that having a good relationship with your CPA is very important. I mean, if you're using the same trusted CPA year in, year out. They know what typical expenses you have, your business has, and they would certainly advise you on what was a legitimate or necessary expense.
Great. Awesome. So Alan had dropped in the chat because a couple of people were talking about it, and that did answer Lewis' question. That did answer his question. Simple retirement plans, SEPs, they're all great alternatives for 401k. So we just want to make sure that everybody is saving. So drop in the chat and let me know, do you have retirement savings for yourself and for your team? Drop in the chat and let us know. Do you have retirement savings for yourself and your team?
And while they're doing that, I wanted to put that in the chat because quite honestly, they're more typical. If you're a small business and you have, somewhere between 4 or 5, certainly up to 10 employees, a simple plan or a set plan or something like that, individual IRA plan is probably more common than a 401k. So 401ks for smaller businesses can be quite expensive because of the regulations that you have to follow and some of the fees to file the returns that go with them. So if you have one of those plans designed simply or designed as a SEP, don't think you need to change that. I'm sure that's working great. And if we can answer any more questions about that, we will. But
awesome. Can we have the next slide? I'm going to go through some of the chat questions that we have real quick. Let's see. So we got great information, Jimmy. They say they really like what you said about the emotional ties. No one would treat a client like you. Thus, people remember how you treat your team and the reasons you are successful. Products can be faulty, but how you handle the issue keeps your business successful. Now, we did have a comment that says, I find it difficult to sell the book of business. My clients have said that if you exit, then they will pick my successor, so they'll rebid the contract. So Lewis, what are you doing to overcome that? And Alan, you go ahead and say what you're going to say.
Well, I saw that question earlier and I was going to comment on it if we had time. My first answer would be, it doesn't have to be that way. And they'll say that. Your clients might say that to you. It's a way of complimenting you on the work you've done and being flattering. The two things that I said earlier, to the extent that you can sit down and say, I know that, I hear that, this is the person that I have hand chosen, or people, doesn't have to be one. This is the succession plan that I have designed. I am confident in it. I hope you will give them the full attention. I expect you will receive the same great service. And then again, if they can see that coordination play out, if they can see you working with that person, if they can see that person or people coordinating with you on whatever service you provide to them, the retention rate can be very, very, very successful. So your clients may be telling you that, but it doesn't necessarily have to be that way. To Lewis, I guess, is who said that. So.
And Lewis, drop in the chat and let us know what kind of business you have. And so Laurie said, this is what we were talking about doing internal transfers, I believe. We thought for the first year we would have monthly meetings to go over books, reports, etc., still maintain control over the money. After a year, meet maybe quarterly or twice a year. So that was Laurie. George said, we do not have an internal buyer, but we do have another industry related company interested. So George, what kind of things where are you in the process of them being interested? Are you looking to sell the business immediately, a year from now? Tell us kind of where that process is. And Michelle says she plans to transfer ownership to her kids. They've already discussed it. Well, awesome. And congratulations for that. Now I did have a question too. So Lori, what she was saying was that she approached her assistant manager about buying the business. She isn't interested in buying the business, but she is interested in managing and running the business. So we are leaning towards stepping away from the business in 4 years, but still owning it. So does the panel have any comments about that? So the question that I was asking her was, so I understand that that's a short-term approach for someone, managing the business, but when it's time to fully exit the business or transition for the business, what is the plan if they just want to manage it but not own it?
Yeah, I would say, first off, kudos to your manager for realizing that they are not necessarily designed to be a business owner. The entire last session, if you were listening to the last session, we talked a lot about that. What is your purpose here? Do you want to be the surgeon or do you want to run the hospital? So kudos to that business manager. The second thing I would say is you have probably shown for many years a confidence in your business to prepare for your lifestyle. The difference is in retirement, you're not there to save it. So if your lifestyle has always been built around your business, as soon as you turn it over to a manager, once again, the more retirement plan you can have, the more income you can have in ways other than your business. The caution I would give you is, if you're in a retirement state and something, it doesn't necessarily have to mean that business manager started doing a poor job. Maybe the economy changed. Maybe something happened. Again, this is a situation where it depends on what kind of business it is. If you're producing a widget and people are buying it and selling it, that's a little bit more predictable. But if that business were to stop being able to produce what you need, and now it has to produce for what you need and the business manager needs, because if all of a sudden the profits start to shrink, you might be able to get your retirement income need, but you can't pay that business manager. The more that business manager decides they don't want to be a business owner, but they see how valuable they are to you, sometimes that person wants a raise. So in that scenario, every raise you give them cuts into your retirement income. So again, the more you can have prepared for your retirement to be successful outside of your business, it doesn't mean you won't ever get paid. In fact, you could get paid more if the business continues to be successful, but you have to prepare for it not to be, for a myriad of reasons. So I read that and wanted to respond to it. It can work that way. You just need to realize that your backup retirement plan is either going back to work or coming up with income in some other way if that business starts to struggle.
Okay, so two things. And so Andrew, one of this, it may be a good for you as well as Jimmy and Alan. So Lewis, we were asking him what kind of business he owned. And this was the question where the clients were saying that if he transfers ownership of the business, that they would, rebid the contract. So it says he makes sure they know my own site, boots on the ground. So for 38 years, he has provided commercial only landscape, installation services, and grounds maintenance to state and federal government agencies with 60 to 90 employees. So this is again, where they were saying that they would rebid it. Any comments to that or feedback to that?
I'll just add kind of what I said previously. Obviously, I had the benefit of an internal transfer, but we started talking about it with our clients, and I think Alan has made the same comment. 5 years before, we had, and Alan made the same comment, state of play. Is there an opportunity for you to stay on in some format so that the current clients see that the transfer is going well, that you still have somewhat of a hand without necessarily being the day-to-day operator?
Perfect. Okay. Lewis, does that answer your question? And so George responded, and George said this was where he had an external person in the industry looking at the business. He said he's looking to sell within the next 12 months. Buyer would like a minimum of 2 years of collaborative transfer of information and business handoff. So Andrew, can you talk to us about that process of how that worked, kind of, because it is sort of similar to your situation, but not exactly?
Yeah, so we had, I would say, maybe somewhat of a loose agreement as far as, I won't say loose. It was built into our contract that Ken could work up to 20 hours a week. Granted, we've been busy and he's worked more than 20, but it was, from a transition standpoint, he agreed that he would work for 3 years, on a part-time basis for ideally 20 hours a week. And he had his, all client communication was kind of coming through me, but he has his own kind of set of projects that he manages himself. I would say all the new work was coming through me and managed by me, if that helps. But to me, having him still on in some capacity was helpful in that transition. And I was fortunate that I had with the internal transfer, I did have somebody that was overbearing and wanted to still be in control. That, I don't know if that's always the case, where you have somebody that, we're going to sell you the business and we want to work part-time, but then they still want to run the business. That was not the case for me, but I could see where that could be troublesome.
So Andrew, how long, just for your particular situation, would you the time needed to do the transfer? 1 year, 2 year, 3 years?
Yeah, so with our business, and Jimmy can speak to this, we'll have a project where we start on a concept for a plan, and it may be 3-4 years before it actually gets, I'm gonna say, constructed, or, just the process takes that long. So it probably depends on the business. If, like Alan said, if you're selling widgets, it's a little bit more predictable. Maybe your turnover in projects or contracts are shorter. But in our case, we do have longer lead times with projects. So I would say 2 to 3 years minimum, probably no more than, I mean, once you get over 5, if you're not able to convince your clients by that time that you are the one to go with, you might not be the one to go with.
Okay. Awesome. All right. So the question that we have on this slide, and then we're gonna go to the last slide. So it's very important for you to strengthen the infrastructure. And so panelists, I want you to talk about why is it important that all of your procedures are documented and that you have systems and you have standard operation procedures for every key business function area: marketing and sales, HR, accounting, project management, customer service, supply chain, all of the essential parts. So why is it important? Why is it important? And then if you have any questions that you want our panelists to answer, I want to make sure that you drop it in the chat because we have about 8 minutes left. All right, so panelists, why is it important that you have all your documents, all your procedures documented, and that you have systems in your business? Why is that important?
Well, maybe I can just go ahead with this one. Just think about it. If people want to purchase that, you can say all you want, but how do they know? That is the dependable, and so that's the documentation coming to play. So people look at your record and then look at your procedure. And any business, the potential buyer, they have enough wisdom. They can see how comfortable they are. Hopefully, when they see the good documentation, all the procedures, and they have enough wisdom to say, okay, well, makes sense. This is duplicatable. So when I purchase your business, I can make the same money, and so they will give you the whole lot more incentive to either give you higher the pay or to conclude the business transaction.
You said it right there. Your business is duplicatable. I think that is the biggest thing. And then we also had Diana said documentation is proof. Joanne said so that the business can run with it without you and still be successful. That's absolutely why you have to have documentation. All right, Andrew and Alan, do you have anything that you want to add about the documentation, or anything that you want to add about the whole conversation that we had?
I'll say one comment. This has been as informative to me probably than, I mean, just being in my situation, listening. I've enjoyed being a part of the conversation. But something that Alan said resonated to me was, knowing your numbers and not waiting, starting from day one. In his situation, he was approached 10 years prior to when he wanted to potentially sell, and because he probably knew his numbers and knew his value, he was able to speak intelligently and bring the most value for his business.
Awesome. Was that the truth, Alan? Is that what happened?
Yeah, it was. I mean, and I could have gone more into my story, but I wanted to be informative for the panelists, not just me telling my story. I said no. I stiff armed First Community Bank for a year and a half before we ever came to any kind of an agreement. And the way I always tell that story is I looked the CEO of this bank dead in the eye and said, I'm 40 years old and got it going pretty good. There's no way your publicly traded shareholders are going to pay me what I want. And I always finish that story saying he didn't, but he got a lot closer than I thought. So, that's an outlier. I almost don't like to tell my clients that story because they think that's going to happen to them. I will say the part that is transferable to the participants today is what Andrew just said. Be ready, know what value might be there, so that if you do get an outlier or you have a conversation different than what you thought, which happened to be right in my backyard, it's kind of like, I feel like saying I somewhat I somewhat won the lottery, but I wouldn't count on that if I were you. And in the last session, we talked a lot about how I was already starting to deal with what I know a lot of our participants today are, which is realizing I just want to be a financial advisor. The size of my business is getting more burdensome than I ever wanted it to be. I'm having to deal with payroll taxes and employees that want time off. I'm dealing with all of these health insurance concerns and the government changing the rules as to how I've got to provide for employees. I just want to go back to doing what I do real well. So I think, to echo what Andrew said, I think I was really in touch with that, so that when an offer came along, I thought, you know what, this seems like it's backwards from what most folks would do, but I think it might be right for me. And when I saw the opportunity to get the short end of the stick, but it wasn't really that short, I kind of listened. So, business sellers that know they may have to get the short end of the stick, if you're transferring to your family, that's okay. You don't mind getting the short end of the stick if it might continue your family legacy and help your children out. It's when it's not your family that they think, I'm gonna get the most that I can. Well, look, sometimes it doesn't always go like that. So that was my story. I had somewhat of a unicorn situation, but as Andrew said, being ready for it and knowing what the value was when it came helped me a good bit.
Well, we love unicorn situations. We love it. So Jimmy, Lewis said, I have enjoyed working with Jimmy for many years on school projects. All right, Jimmy, what is your closing advice that you'd have?
The reason we always have to ask ourselves, why are we going into the business? And everybody have a different answer, but I think the common, the denominator is we are doing that because we have a passion about what we do. And so that is, the twofold way. One is your clients, and B is your employee, your staff. Actually, both should be important to you as a small business owner. You have to care about your client, you care about your staff. So whatever you do, you need to plan ahead and keep that in mind, because you don't want to sell the business just for the money, but knowing that your client will not get good service. Or you don't want to sell your business so you can just jump out of ship and leave your staff hanging there, and they be dedicated and give you their loyalty, for a lot of the time. So those two things are also very, very critical in your exit planning. So how am I going to take care of my client, and how can I take care of my staff? After that, then it's about how can I take care of myself. Now, hopefully, if you have done what everybody has said, starting your SEP or your 401k early, so you have a whole lot more flexibility. And also, if you can get over the hump of your legacy versus the money, that also will be another the easier decision. So anyway, think about your client, think about your staff, and then think about your legacy. That's the three things I want to offer people to thinking before they want to complete exit.
You're on mute.
You're on mute, Renee.
And I was saying something powerful, y'all just missed it. I was saying that I don't think I could have said it better than Jimmy just said it, about really thinking about how to take care of your clients, your staff, your legacy, and then yourself. So I want to thank everybody for coming. Last slide, we're going to have Camille to tell you what our next steps are going to be. And it has been wonderful sharing this time with you guys. So let's give our panelists a hand. And drop in the chat as Camille is talking. Did you enjoy this session, or did you enjoy this session? Drop in the chat and let us know.
So thank you, T. Renee, for guiding us these past few weeks throughout this process. It has been so wonderful for you to take charge on this. And I do want to thank our panelists for volunteering your services today and sharing your stories. We hope that these sessions have put you on course to prepare or to finalize your succession plan. We will send you an email that contains the links and the webinars of the past 4 sessions. So please be on the lookout to expect that email. So the next steps, next slide, we will share with you also a business succession planning toolkit, which will include a checklist of the foundational work and other areas that you need to address with your planning. You need to complete the toolkit. Please do. And we will also send you a survey to get your feedback and to see if we can support you with helping your business grow, to support you with helping to prepare your business plan. So we hope that these sessions have been very beneficial for you. We thank you for investing your time in yourself. As it has been said throughout this series, the best time to start or to finalize your succession plan is right now. Don't delay it any further. We appreciate your feedback in completing the survey. Thank you and have a wonderful succession planning. Thanks. Bye-bye, everybody.